we're good to go ahead and get started. Thank you again for joining us virtually today. I'm your host. My name is Sydney Rutledge. I'm a financial advisor here at Bogart Wealth. Today, we're going to be going into our retirement readiness series, and today's topic for the webinar is after-tax rollovers and the mega backdoor Roth. Again, if you didn't hear me previously, I do have the question and answer box open, so feel free to drop any questions that you have there, and I will get to it at the end of the presentation. Let's dive in today. Before we get to the main topic of the webinar today, which is after-tax rollovers and the mega backdoor Roth, I want to tell you a little bit about Bogart Wealth as a firm, who we are, how we're organized, and all that good stuff. So Bogart Wealth is a fiduciary. We're a registered investment advisory firm, or RIA. We have just under $3 billion in assets under our umbrella here. We are the trusted advisor to over 1,300 households. The majority of those households that we serve are major oil and gas retirees or current employees. So we do have kind of a niche in that sector. RIAs, being fiduciaries, we're independent of any big broker dealers, which means our duty is to our clients. Our duty is to you. We legally have to put our clients' interests above our own. We're very proud of that fiduciary duty that we uphold. This is our executive leadership team here at Bogart Wealth. We also do have a full advisory team here at the firm, as well as in-house portfolio management, designated client service teams, financial planning team, and then we also have full staff HR, business development, training, and marketing as well. So very well-rounded group here at Bogart Wealth. We also have 3 office locations. I'm located out of our office in the Woodlands, Texas. We do have one in Houston, and then headquarters is in McLean, Virginia. At the center of what we do here at Bogart Wealth, your plan is at the heart of everything that we do. We always want to make sure that we're checking your numbers, running your retirement analysis, and checking it against your progress. So we focus on financial planning. We're a financial planning centric firm. Everything else is built around that. Really encourage you. We have no cost for our financial planning, going through our financial planning process. If you've not sat down yet with one of our advisors to get that done, highly encourage you to take the first step, reach out, make an appointment. Any one of us on the team here would be very happy to give you kind of a first run of your financial plan. So highly encourage you to do that if you have not already. Now, let's get into today's topic. As I mentioned, this is part of our retirement readiness series. We put out a lot of educational content here at Bogart Wealth. These are just a few of the topics: retirement planning timeline, retirement income planning. So that's how you do a cash flow once your paycheck stops from your employer. How do you kind of turn your assets into a cash flow in retirement? We talk about Social Security planning, tax planning, estate planning, NUA and post-retirement strategies, long-term care planning, Roth versus traditional 401k, and then today's topic is mega backdoor Roth conversions. So we'll get into that today. Here's the agenda for today's webinar. We're first going to start off by talking about an overview of the different types of retirement plans. Those can get kind of confusing, hoping to add some clarity around that today. We'll then go over Roth conversion basics and then reasons to convert. Some people think that Roth conversions make sense for everybody, and they do make sense for a lot of our clients we work with. Not usually the best strategy for some people. So we'll go into reasons to convert to Roth as agenda item number 2 today. And we're also going to talk about how the mega backdoor Roth strategy works, the mechanics of it, how it's calculated, all of that. Then we'll talk about in-plan Roth conversions and after-tax withdrawals. And then we'll finish up with a couple of examples on the mega backdoor Roth. Okay, so retirement accounts, qualified accounts. These are your standard retirement accounts that you hear people talk about. Most commonly is a 401k. IRAs are also qualified accounts. Some people have 403bs or 457s. Those are typically nonprofit accounts, or government accounts will be 457s and 403bs. The primary, and you'll hear me kind of say this throughout the webinar today, usually I will kind of interchange retirement account and 401k, because I know that most of the people that we work with and that we're reaching typically have 401ks. If you hear me say 401k, just know that I'm talking about retirement accounts in general. So there's a good part about qualified accounts. The first is that your salary is contributed on a pre-tax basis. It saves those dollars from being taxed at your highest marginal rate. So you save taxes every year while also saving for your retirement. You also pay no taxes on the gains or the appreciation of the investments inside that retirement account until you withdraw it. You pay no tax on dividends. And in most cases, most companies offer a company match on a traditional 401k contributions. So really good parts about qualified accounts. There's also another part about qualified accounts, which is that there's a tax penalty, an early withdrawal penalty. of 10% if the money is taken out early. Early is considered prior to age 59 and a half. That's considered an early withdrawal. The other part is that every dollar, which is both the original cost, the cost basis of the investments inside of the 401k, and also the appreciation, all growth, is taxed as ordinary income when withdrawn. So that's at your normal marginal rate, it is taxed as ordinary income. You also make a promise to take out every dollar during retirement. Those are called RMDs, right? Pesky RMDs. The government enforces this promise. There's legislation behind it. There's a formula that dictates the schedule for required minimum distributions, or RMDs, to be taken out on those pre-tax dollars. For most people, those RMDs will kick in at age 75, early to mid 70s. It depends on your birthday. But for most people at this point in time, it's age 75 when those RMDs kick in. Then there is a substantial tax penalty for the failure to withdraw those required minimum distributions on their designated schedule. Moving right along, employer-sponsored retirement plans do have contribution limits. So there is a limit to the amount of dollars you can put into these qualified accounts. For 401ks, 403bs, and Roth 401ks, the employee's deferral amount is limited to $23,500 in the year 2025. There is a catch-up amount. If you're over age 50, they allow you to save more into your retirement account. That amount is $7,500 for those individuals over 50. Now that's the employee's deferral amount, the amount that you as the participant can put in to that qualified account. Now the total defined contribution plan limit from all sources is $70,000. With the catch up on top of that, it's 77,500. Now that all sources, that includes everything from employee deferrals, after-tax contributions, Roth contributions, and also the company match. So that 70,000 or 77,500, if you're over age 50, that's going to be the contribution limit for all the sources in the 401k. That's the maximum amount of dollars that can go into that account in the year 2025. These amounts are typically indexed for inflation. We'll see them go up a little bit every year, every couple of years or so. So they do have an inflation amount on there as well. Why this matters is because we have a progressive tax bracket system in the United States. I've put the table on the chart here. You can see the different filing statuses: single, head of household, married filing jointly, and our tax system works like buckets. So let's take the married filing jointly amount, for example. If you have a married filing jointly income of less than $23,850, all of those dollars are taxed at 10%, making your average tax 10% because it's the same thing. You fill that entire bucket up. All those dollars are taxed at 10%. Any dollars over 23,000 but less than 96,950 are taxed at 12%, making your average tax 11.5%, and so on and so forth. This matters when we're talking about 401k contributions and withdrawals because of this bottom section right here. Contributions to your retirement account are made at your marginal or highest tax bracket, whereas withdrawals are made at your average tax rate. So that's why this matters. Another type of qualified retirement account is a traditional IRA. IRA stands for individual retirement account. Traditional IRAs are done on a pre-tax basis. The dollars that go into a traditional IRA are pre-tax dollars. Now there are limits. The annual limit, if you're under the age of 50 years old, you're limited to only being able to put in $7,000 to a traditional IRA. You get another $1,000 of catch up for a total of $8,000 if you're over age 50. If you are not planning on deducting that contribution from your ordinary income, then there's no income limit. You can contribute that $7,000 or $8,000 if you're above 50 and make any amount of money that you want. However, one of the benefits of a traditional IRA is that you can deduct that contribution against your ordinary income, so long as you make less than these phase outs. So if you're covered by a retirement plan at work, then that amount, if you're single, is $79,000 to $89,000. It's a range, and it kind of gets complicated if your income falls within that range. It is a prorated amount. If you are married filing jointly, then the range is $126,000 to $146,000. If you make less than that range or somewhere in that range, you are able to deduct either all of or part of your traditional IRA contribution. If only one spouse in the household, if you're married filing jointly, if only one spouse is covered by a retirement plan, then the limit is $236 to $246. So a little bit higher of a limit there. In addition to traditional IRAs, there are also Roth IRAs. 401ks can also have a Roth bucket as well. Roth accounts are great in general because your salary is contributed on an after-tax basis. Usually the company match that I mentioned earlier that a lot of companies do, that is on a pre-tax basis. Some companies nowadays have started to roll out Roth matches as well, but that's not very standard at this point. Main reason why we love Roth accounts and Roth IRAs is the tax-free growth on the money that's invested in the Roth. You also get tax-free withdrawals of your principal at any point in time. So the dollars that you contributed to a Roth IRA, you can always take out at any point in time. You also get tax-free withdrawals of the growth, assuming a couple of things. There's two main rules that have to be met in order to get that tax-free growth advantage of a Roth IRA. Number one is you have to be over the age of 59 and a half, that magical age of 59 and a half. The Roth account also has to have existed for 5 calendar years. There's a penalty, an early withdrawal penalty of 10% if the appreciation or the gains on that money is taken out early before 59 and a half. Other great thing about Roth IRAs is that they are not subject to RMDs. They're not subject to required minimum distributions, which makes them great candidates if if you have large pre-tax assets. That's typically why people convert to Roth IRAs, is they're trying to remove some pre-tax assets from the required minimum distribution calculation. So Roth IRAs are great, not subject to RMDs. However, Roth 401ks may be subject to RMDs because they're in a retirement plan. Your beneficiaries also inherit Roth monies tax-free, which is great. So we talked about limits for traditional IRAs. There are also limits for Roth IRAs. The limit is the same for contribution, $7,000 if you are under the age of 50. If you're over 50, you get an extra $1,000 for $8,000 total. However, it is more difficult to get money into a Roth IRA, especially if you are a high income earner. You can see those income limits there, whereas traditional IRAs, you can contribute if you make whatever amount of money, but you're only able to deduct that contribution against your ordinary income if you make a certain amount. With Roth IRAs, you're phased out from contributing completely if you make over these ranges here. For single, it's over 165,000. For joint, it's over 246,000. As for contributions, important distinction between contributions and conversions. There is no income limit on Roth conversions. You can theoretically convert as much to a Roth in 1 year as you want to. You just have to be willing to pay tax on that converted amount, which we'll talk about later. Okay, let's get into the basics of Roth conversions. A conversion is a penalty-free taxable transfer of amounts from your traditional IRA to a Roth IRA. You can convert all of or part of the money in your regular IRA to a Roth IRA. You just have to be willing to pay taxes on it because it is taxable as ordinary income to you. Prior to 2010, there were rules around conversion. You had to have a modified adjusted gross income, or MAGI, we call it in the industry, of less than $100,000. So if you made more than that before 2010, you couldn't even convert. Now they've removed that ceiling and you can contribute as much as you're willing to pay taxes on. So that's kind of the rule going forward. In addition to a traditional IRA that can be converted to a Roth, you also may be able to convert those following accounts at the bottom. So your 403B, your SEP IRA, a simple IRA, which are less common but still out there. Section 457 plans, and then also other qualified plans as well, can be converted to Roth IRAs. So some of the reasons to convert, and again, I mentioned at the beginning, it makes sense for some people, but also not for others. Regular contributions to Roth IRAs are allowed at any age. So as long as you have earned income, you can contribute to a Roth IRA. So that's one of the reasons. Qualified distributions are income tax free. As we mentioned, if you meet that 59 and a half and 5-year rule, then the growth and the principal is withdrawn tax free from a Roth IRA, and there's no required minimum distributions, which is great. Here's a couple of reasons why conversions may be the right strategy for you and your family. If you're looking to diversify your tax exposure, adding a Roth bucket, there's a couple different types of money. We've got cash, you have pre-tax money, brokerage money, and then Roth money. For lots of our high earners, you've been precluded from adding money to a Roth IRA in any capacity for years at some point. So doing Roth conversions can get you access to that Roth bucket of money, which can really be advantageous to your long-term goals. It's nice to have a big pile of tax-free money sitting there that you can access as long as those two caveats are met. Was your income too high to participate in a Roth IRA before the TIPRA changes? So that's another reason why you may want to convert. Also may be advantageous to convert if you think that taxes will be higher in the future. You're wanting to pay taxes now and then avoid paying higher taxes in the future. Could be a reason to convert. And then the last one, and this is usually a big factor for some of the people that we work with. Do you want to maximize the wealth transfer to your children? Inheriting Roth dollars are always better than inheriting tax-deferred dollars, like pre-tax dollars, because it doesn't matter when you take those dollars out, even if they are on that 10-year schedule, which is common. If beneficiaries inherit a retirement account, that account typically has to be empty at the end of 10 years after the decedent passes. Whereas with Roth monies, you don't care if it has to be empty at the end of 10 years because you don't have to pay taxes on those withdrawals. But with IRAs and 401ks, you do. So that could be another reason to convert to Roth. Here's some factors favoring the Roth IRA over pre-tax. So I got a question that kind of this will hit on it. So the question was, my employer has a Roth 401k, 401k, and after tax. What are the advantages/disadvantages of each one? The kind of long and short of that particular question, I can answer it generally, but it also pertains to your personal situation. If you're trying to determine whether or not you should be contributing to your retirement account on a pre-tax, after-tax, or Roth basis, you probably need to sit down with one of us to run your numbers just to see, because your income is different than other people's. So that can be a personal answer. But in general, these are some of the reasons that would factor contributing on a Roth basis to your employer account, or just in general. Again, if you think income tax rates will be higher in the future, it'd be better to contribute Roth now, pay taxes now, rather than pay taxes later. If you expect your income and your spending to go up significantly faster than inflation between now and the end of your plan, then it would favor the Roth. If income tax rates all go up in the future, for example, to balance the federal budget, you might want to contribute on a Roth basis. If you're going to be in RMD prison, we so lovingly call it RMD prison, whereas when you have surplus RMDs, this is when you have pre-tax assets that are so large that you're projected to have to take out more in RMDs than you're planning on spending. It's a good problem to have, but it is a tax problem. So removing some of those assets from the RMD calculation and moving them to the Roth bucket may be a better option than just continuing to add to that pre-tax bucket. Also, if you anticipate leaving a large legacy to family or other individuals. Let's get into talking about in-plan conversions versus tax-paid withdrawals. That's kind of the meat of the webinar today, is to answer this question, where we're talking about after-tax withdrawals, the mega backdoor. This kind of sets the stage for that. So you can convert the tax-paid balance within your 401k or savings plan, as it's commonly called, to the Roth bucket as an in-plan conversion. Prior to doing this, consider the implications to your net unrealized appreciation strategy. Again, this is personal to everyone. It depends on the amount that you have in your employer-sponsored retirement plan. Probably best to sit down with an advisor to have them run through your situation to determine if this is a good idea or not. A withdrawal, tax-paid withdrawal, is very different to an in-plan conversion within your 401k. That in-plan conversion can have some unexpected tax implications. So I'll quickly run through those. Employees that are younger than 59 and a half, they can convert a portion or all of the balance of their after-tax and general accounts to the Roth conversion account. However, funds in the before tax account are unable to be converted. So just keep that in mind. If you're older than 59 and a half, you can convert all or a portion of your non-Roth accounts to the Roth conversion account. A lot of people ask the question of if there's employer stock involved, how does the basis come into play? The answer is that the basis of your stocks doesn't matter for in-plan conversions. Most attribute a cost basis to shares in a pre-tax account, but for tax purposes, everything in a pre-tax account has a basis of 0 because we're not being taxed on the gains. We're only being taxed on the total amount of income. Here's an example for how things would be taxed if you did an in-plan conversion. If the entire balance of the after-tax account was 60% contributions And then those contributions have obviously been invested and they've been growing. So if 60% of the after-tax account as a whole was made up of contributions, the other 40% was made up of appreciation or growth on those contributions. Then if you converted 100% of that after-tax account to Roth, 40% of it would be taxable as ordinary income to you in the year that the in-plan conversion is done. If you only converted half of the after-tax account, 50% to the Roth, then 40% of the 50% would be taxable as income, and so on and so forth. So really just want to make sure that we're making the distinction between in-plan conversions and tax paid withdrawals, which we're going to get to. In-plan conversions are taxable, or at least a portion of them are taxable in the year that they're done. Okay. Moving on to tax paid withdrawals. Again, prior to doing this, want to look at your AUA opportunity if that's something that is part of your savings plan. Rather than an in-plan conversion, you may consider withdrawing the tax paid credit balance out of your 401k and putting it into a Roth IRA to continue to grow tax-free outside of your 401k. In order to do that, there is a portion, the attributable gain, must be also withdrawn and put into a traditional IRA outside of the 401k. This is different than an in-plan conversion. It is technically an in-service withdrawal, but it is a rollover from one retirement account, the 401k, to another retirement account, the subsequent Roth IRA and traditional IRAs, which means it is non-taxable to you. There's no tax implications at all to doing a tax-paid withdrawal. That's why we love it so much, because it gets those dollars out of the after-tax account, growing tax-deferred, and gets them into a Roth IRA, growing tax-free. That is the mega backdoor strategy. This is an example of the tax-paid withdrawal calculation and how it's done. It is a prorated amount, right? We talked about if 60% of the after-tax account is contributions and 40% of it is gain, then a certain percentage of it would be taxable to you. In the case of the mega backdoor or tax-paid withdrawal, the portion of the gain has to go to a traditional IRA. How that calculation is done, the total after-tax balance, the after-tax account balance, is divided by the pre-87, post-86 tax paid balance. That's your actual amount of contributions to get a percentage. That percentage is then applied to the after-tax account balance, and those numbers respectively have to go to their Roth IRA and traditional IRA counterparts. So again, this is an example on the page. If you're curious, if you see on your 401k statement, or you know you're contributing to your 401k on an after-tax basis, and you're curious to know how much you could actually get out of your 401k and into a Roth IRA, let us know. Send us your statement and we'd be happy to take a look at it and do this after-tax calculation for you and help you through that entire process of making sure everything stays tax deferred, getting it into Roth IRA and traditional IRA. We're happy to help with that. Okay, some examples. Before I get to these examples of the mega backdoor, I did have another question come in, so I want to hit on that first. Do you have to be retired to convert the after-tax and general accounts? Do you have to be retired to convert the after-tax and general accounts? No. So you can convert after tax in general whenever you want to. It's just going to be taxable in the year that it's done. Keep in mind that if you separate from service, and you're retirement eligible, but you're leaving your 401k at the provider until you're 59 and a half, if you do an in-plan, or excuse me, if you do a tax paid withdrawal after you've separated from service, that counts as your one pull per year. Every 401k provider is different, but in this case, there is a rule where you can only pull once per year after you're separated from service. That after-tax withdrawal will count as your once per calendar year. Could make things a little tricky down the road. As far as being retired, once you're retired, theoretically, what would happen? You could leave the 401k at the provider and then do those in-plan conversions. You're able to convert as much as you're willing to pay taxes on, so no issues there. But once you're retired, you can convert as much as you want. Probably what would be more advantageous is for you to move the 401k out of the 401k provider, get it into an IRA, and then convert from there. Just have a little bit more freedom. So hopefully that answers your question. If it didn't, please feel free to send us an email. We'd be happy to look at your particular situation and kind of how everything looks for you. All right, let's go back to the mega backdoor Roth. This is example number one. We're talking about an individual here who has a total compensation of $235,000. The company does match 7%, and this person we're assuming is over age 50, so they're doing that catch-up contribution to their 401k. Okay, base is 235, marginal tax bracket is 24%. They're contributing 10% pre-tax to their 401k, nothing to Roth, and 5% of their paycheck is going to the after-tax account. They are doing that catch-up contribution of $625 a month because they're over age 50. So here are the totals for one full calendar year with this person's numbers. Pre-tax, 10% of their salary is $23,500, which is the pre-tax limit for employee deferrals. Again, they're not doing anything to Roth. They are contributing $11,700 to the after-tax bucket of their 401k. And then they're also doing the catch-up $7,500 a year. That's pre-tax. The company match at 7% gives us $16,450 in company match for a total contributed to this person's 401k for the year 2025 of $59,200. Remember, they're over 50, so their total amount of dollars that is legally allowed to go into their 401k is $77,500. You are able, in some cases, to make up that difference by making a special contribution directly to the after-tax account. You can write a check into your 401k with after-tax dollars. It will go directly into the after-tax account, and it will kind of close that gap to max out the deferred contribution limit to the 401k. We're going to assume that this person did that. They did a special contribution to their 401k of $18,300 directly into the after-tax, which this dollar amount, oops, go back. This dollar amount of $18,300 tacked on to the after-tax contribution of $11,500 makes $30,050 eligible for the mega backdoor in the current tax year. Where the mega comes in, I'm sure many of you have heard of the standard backdoor. That's just contributing dollars to a traditional IRA and then immediately converting them to a Roth IRA. Well, you're only limited to $7,000 if you're under 50, $8,000 if you are over 50. $30,000 is several years worth of regular backdoor contributions, which is where the mega comes in. So we have the comparison here. So it's $11,500 plus $18,300 for a total of $30,050. That's a lot more than the $7,000 direct Roth IRA limit. Now, how the mega backdoor actually mechanically works, that's what this slide does. So you make that after-tax contribution of $30,500 into the traditional 401k. So it makes a pit stop in the middle there. Then you immediately do a direct rollover or backdoor, mega backdoor of that $30,050 into a Roth IRA, and it continues to grow tax-free from there. The growth portion does have to go to a traditional IRA, but again, it doesn't come out directly to you as a participant. It retains its tax deferred status and continues to grow tax deferred in that traditional IRA, making $0 taxable to you in the year that this transaction is done. All right, we got one more example here for you, and then we'll kind of wrap up and talk through questions if there's any more. So example number two, same company match of 7%. We're talking about a higher annual compensation here of $400,000, making this participant's marginal tax rate 32%. We are assuming that they're over age 50. They're contributing 5.875% of their base salary to the pre-tax bucket of their 401k, 0% to Roth, 5% to after-tax, catch-up of $625 a month, very similar as our previous example. But the numbers look a little bit different because we're talking about a higher income here. So again, pre-tax, they're maxing out the pre-tax bucket all the way up to that $23,500. 0 to Roth, $20,000 to the after-tax bucket in their 401k, the catch-up of $7,500, company match of 7% gives them another $24,500 into their 401k for a total of $75,700. That's still $2,000 short of that $77,500 deferred compensation limit set by the government. So they are able to make a small special contribution of about $2,000 if they did want to max out that amount. So direct Roth IRA ineligible. Remember, we had those income phase outs where if you make too much money, you're not eligible to even put money directly into a Roth IRA. This person meets that because they make over 400,000. Whereas our previous example, they were just under that threshold. So they would be able to directly contribute to a Roth, but the mega backdoor is much more. So it's more advantageous to do it this way. Quick note on the 401(a)(17) limit. So the company match is limited to the 401(a)(17) limit. This year in 2025, that limit is 350,000. That means that companies only have to apply their, in this case, 7% match to a compensation limit of 350,000 and below. Any compensation that's over that can typically go to some type of non-qualified or special account. Some companies choose to do that. There is kind of a supplemental piece that they will continue to pay that match on. In this case, that's why the company match stops at that 24,500 because we reached the 401(a)(17) limit. So I mentioned the $2,000 after-tax contribution directly to the after-tax account. We do assume that this person makes that special contribution. This 2,000 tacked on to the 20,000 of payroll deferrals directly into the after-tax account gives them $22,000 eligible for the mega backdoor in this calendar year. Again, we'll go through the kind of mechanics of it. You make the $22,000 after-tax contribution directly to the 401k. It makes a pit stop in the traditional 401k and then is immediately directly rolled over or backdoored into a Roth IRA and continues to grow tax-free. So that is how the mega backdoor is kind of completed mechanically. I suggest having an advisor help you if this is something that you're interested in. I suggest having an advisor help you through this process at the very least to help you with the calculation of, the amount of money that's in your 401k. If you've been routinely spilling over into the after-tax bucket for several years, you probably have a decent amount of money in that after-tax account that's eligible to be backdoored, mega backdoored, and go into a Roth IRA and grow tax-free. Again, I've mentioned this a couple of times. Usually, typically the people that we're working with, we're talking about high income earners. So they've likely been phased out of contributing directly to Roth IRAs for many, many years. And this mega backdoor may be the only way that you're able to actually get material funds into a Roth IRA. So definitely sit down with an advisor and have them run your numbers, see if this is a good strategy that makes sense for you. So that's all we've got on the mega backdoor versus in-plan conversions for today's webinar. I mentioned this kind of early on in the presentation here. We don't charge for financial planning. We think that it's in our clients' best interest for everyone to have access to certified financial planners like myself. Sit down, run your numbers, see if you are kind of matching up against your financial goals. Sit down with us, get in touch with us, and we would be happy to talk with you and your family about how you're stacking up for a potential retirement, or if you're already retired and you want to just have us do a financial checkup for you. We're definitely happy to do that at no cost to you. We'd love to get to know you and your family better. Here's how to get in touch with us here at Bogart Wealth. We have a number that you can call. We do have those 3 office locations. We put out a ton of educational content. Our website, www.bogartwealth.com, has a lot of different events on it. You can find all of our webinar recordings there as well. We also have a YouTube channel where we post a lot of different things on. Follow us on Facebook, LinkedIn, Instagram, YouTube, all the things. There's a lot of different things that we put out all the time. If you want to get in touch with us, you can do that on any of those platforms. So thank you so much for joining today. I really appreciate your time. This recording will be up within a couple of days if you want to rewatch it. So thank you so much. If there are any questions that anybody has, please put them in the chat now, and I would be happy to answer it. I'll give it a minute or so, and then we will kind of close out for today. It will be posted in a couple of days on YouTube. Yes, it will. And this webinar is being recorded, and you'll see links to it on our website as well as YouTube as well. I got another question that said, can you pay the conversion taxes with account funds? Can you give me more clarification by what you mean on account funds? To answer kind of the general questions, like how do you pay the taxes on a Roth conversion? Typically, we want to be doing that with after-tax dollars in a brokerage account, maybe cash you have sitting in a bank account. But as far as in-plan conversions, you would have to come up with the money to pay those taxes yourself. And I hope that answered your question. If it didn't, if you could give me more color around that, I might be able to answer better. Alrighty, it doesn't look like the questions have slowed down a little bit, so I think we're good for today. If anybody has any follow-up questions, again, feel free to email myself or any one of our other advisors here at Bogart Wealth. Be more than happy to answer your question for you. Thank you all very much for your time today. Hope you have a great rest of your week.